Good morning. Welcome to Chapter 6. So probably the most important thing in this chapter, it's all about inventory, by the way. So Chapter 6 is all about inventory. The most important thing for you to understand is this relationship. If you understand this relationship, you can pretty much solve any of the problems. So the company has inventory, which is an asset. When they purchase goods that they're going to resell, it goes into an asset account called inventory. When they sell it, it moves out of inventory to cost of goods sold, and cost of goods sold is an expense type of account. So when you look at that relationship, you talk about what I started with inventory at the beginning of the period. I add my purchases during the year, and I come up with this total inventory that I could have sold. We call that cost of goods available for sale. And that number right there splits into two things. So this is what's important. These two things always add up to this. So if you can calculate either ending inventory, what you have left, or cost of goods sold, what you sold, you only have to calculate one of those. So for instance, I had 110,000 available for sale. I did a physical inventory and found out I had $30,000 left in inventory. That must mean that my cost of goods sold is 80,000 because 30,000 plus 80 equals 110. This is extremely important, this relationship. And most of these problems you solve start here from this total inventory available for sale line. And then you're asked to calculate these two things. We do have some different methods to calculating inventory. Why do we have methods for calculating inventory? Don't we just count it? Sure, we count it. But the problem is we don't always pay exactly the same thing every time we buy something. Prices go up and down. So how do we know? Think about Ace Hardware with all of their screws and bolts and nuts. Do you suppose they use specific identification and know what each screw costs and when it came in and when you sold it? Probably not. They probably use one of the three inventory assumptions. So specific identification is actually matching each unit of inventory with its actual cost and tracing it right out to the customer it was sold to. Things like cars and things like that. Those are big items. They're uniquely identifiable, so it's easy to track them. Most companies have inventory. Think about a restaurant. Are they going to track a certain piece of fish from the time it comes in the door to the customer's plate? Probably not. What they're going to do is say, I purchased all this fish and this is how much I have left, so therefore, this is how much I used. The question is, how do we assign costs to those that remain in inventory and those that are sold? We use these assumptions. First in, first out, last in, first out, and weighted average cost. Keep in mind that these are assumptions. If you think about a grocery store, you probably think the first one in is the first one out the door is what they should be using, right? Because if they sell the older stuff first, then nothing goes bad. But if they sell the new stuff first, the old stuff goes bad. Well, that's a physical flow of goods, and I'm sure that's the way they do it. But that doesn't mean they use first in, first out. This is an inventory assumption. Doesn't match the physical flow of goods. So first in, first out assumes that the first units I purchased are the first ones sold. Last in, first out assumes the last units I purchased are the first ones sold. And a weighted average just takes a weighted average cost of all the inventory items. So I want to work through a few examples, but I wanted to give you some background first. Okay, we're going to start with exercise BE, brief exercise 6-5. This is straight out of your textbook, so you could open your textbook if you want and follow along. During the year, Wright Company sells 470 remote control airplanes for $110 each. The company has the following inventory purchase transactions for the year. So they list the beginning inventory. Remember the graphic. Beginning inventory plus purchases equals cost of goods available for sale. What did we have that we could sell? Well, we started with 60 units and they cost us $82, and you multiply that out and get a total cost. On May 5th, we purchased 250 units and the price went up. On November 3rd, we purchased 200 units and the price went up even further. So we had 510 units that we could sell with a total cost of $44,170. How do we determine which of those airplanes to assign which cost to? It depends. It depends on our cost assumption. So we're asked to calculate ending inventory and cost of goods sold for the year, assuming the company uses FIFO. First in, first out. So I'm going to move this up just a bit. So BE65 FIFO. So we're asked to calculate ending inventory and cost of goods sold. Now remember what I told you, you only have to calculate one of those. So let's calculate the easiest one. Let's calculate how many units they have left. So let's do this, units left. We started with 510 units and we sold 470 units. So that means we have 40 units remaining. Is that correct? Yes, it is. So we have 40 units left. So we either need to cost out the 470 that were sold or the 40 that are left. And it's easier to look at the 40 that were left. 40 units. And we're using the assumption first in, first out. So the first units that came in were the first ones that were sold. So the ones that are left are the last ones we purchased. So we have 40 units left at $90. 40 units times $90 equals $3,600. Now, we could do cost of goods sold. We could say 470 units were sold, 60 at 82, 250 at 85, and the remaining amount, which is 160 at 90. And I could add all that up, multiply it out, and add it all up. But I don't really need to do that because I know those two numbers must equal 44,170. So 44,170 minus 3,600 equals 40,570. That's my cost of goods sold. Those two together equal $44,170. Now I could work this out. I could say 60 times 82, 250 times 85, and this is 4920. This is 21,250. And then 160 of the last ones. And those are at 90. So that equals 14,400. And then I could add all of that up, and that would be 40,570. Oops, sorry. 40,570. So I can double check myself, but I don't need to do all that math. In our case, it's not so hard because we only had a few purchases. But what about if we have a company that has thousands and thousands of purchases? It's easier to do it the other way. And of course, we do in the accounting world have software that does this. but you need to understand what the software does. And it does it the same way, it just does it for you. So let's look at BE 6-6. Same information, except now we're assuming the company uses LIFO. Okay. Last in, first out. How many units do we have left? Well, that doesn't change. What did we have up here? We have 40 units left. So units left are still 40. Okay. Ending inventory, 40 units. Now let's look at this. First or last in, first out. So the last ones that came in were the first ones that went out. So which ones are left? The first ones that came in. So in this case, we have 40 left at $82. And that would be $4,920. Cost of goods sold? Well, we could go through it and we could say last in, first out, 200 were sold, 250 were sold, and then another 20 were sold. Or we could just take $44,170 minus $49.20 equals our cost of goods sold would be $40,890. This plus this equals $44,170. And again, I could calculate this. I could say last in, first out, so that means 200 times 90, which is 18,000. 250 times 85 is equal to 21,250. And then 20 of the beginning ones at 82, and that equals 1640, and that totals 40,890. And if you add up the units, it's 470 units. And if you look at the problem, it says they sold 470. All right. BE 6-7. So we've done FIFO, LIFO. Now we're going to do weighted average with the same information. All right. So BE 6-7, weighted average. This one is a bit simpler because we just need to calculate the weighted average cost. And by weighted average cost, that means we take the totals. Don't do it by row and then add them up or get an average of those. Do the weighted average, which is the total. So that would be $44,170 divided by 510 units. You want to watch your rounding here and round the way it says in your problem in Connect. That's 86,6078 per unit. Ending inventory, 40 units still. 40 units times 86.6078 equals 3464.31. Now you can do the same thing here that you did on the other ones. So that's ending inventory. This is cost of goods sold. We can take $44,170 minus 3464.31 equals 40,705.69, and it's a rounding thing here, so just be aware of that. Those two together equal $44,170. Or I could simply take the number of units I sold, 470 times 86.6078, and come up with 40,705.69. That's the weighted average. One more, and that's BE 6-8. We're asked to calculate ending inventory and cost of goods sold, assuming the company uses specific identification. So if you take the number of units that were sold, which is 470, so 230 units plus 180 units, it literally tells you which ones were sold. So we need to calculate it. Let me get a blank sheet here, and then let's look. So it says 6-8, not 7-8. Actual sales by the company include its entire beginning inventory, which is 60. So 60 times 82, and I need to write that down. 60 units times $82, and that's $49.20 because it's up there. 230 units of inventory from the May 5th purchase. So 230 units from the May 5th purchase right here, which is 85. 230 times 85 is 19,550. Okay. And 180 units from the November 3rd purchase. 180 units from the November 3rd purchase, and those cost $90. And that equals 16,200. Okay? If you add those up, that equals 40,670, and that's our cost of goods sold. So notice on the specific identification one, they told me what was sold, so I think it's easier to calculate what was sold instead of calculating what was left. We could calculate what was left. We know there's 40 units left. There's none from beginning inventory because we sold them all. Since we sold 230 from the May 5th purchase, and let me label that, May 5th, then that must mean there's 20 of those left. And if we sold 180 from the November 3rd purchase, that means there's 20 of those left. So ending inventory, we can still do it the same way, $44,170 minus $40,670, and that gives us $3,500. Or 20 units times $85 plus 20 units times $90. Or $3,500. So those are the three methods, three assumptions plus the actual. So the first one we did was FIFO, then we did LIFO, then we did weighted average, and then we did actual, specific ID. You need to understand how to do these and understand the relationship, because this is what most of the chapter is about. The other thing in this chapter is the perpetual and periodic inventory system. So in a perpetual inventory system, we record everything as we go. So we always know what's in inventory. Most companies do this now because they have point of sale systems that track inventory. Periodic system does not maintain a continual record of inventory. In other words, everything that goes in and everything that goes out. We wait until the end of the period to adjust for purchase and sale of inventory. Think about restaurants. They might fall in this category. Some of them may be able to do a perpetual inventory system because they know the cost of a plate of food. When it goes out, it's entered into an electronic inventory system. Smaller restaurants will do a periodic inventory system, typically once a month. Some of them do it once a week. Some even do it every day. So we will look at purchase and sale transactions in a perpetual inventory system and a periodic inventory system. I'm going to use this spreadsheet to do this. So we're asked to do transactions for Littleton books. We're asked to do journal entries for them. So what we're going to do is just enter the journal entries. And I think I have the rest of this problem off to the side over here. Nope, I guess not. Well, so we'll just use this one. So we're going to do problem E69, which is about Littleton books. So they have these transactions during May. We're going to record these transactions. So they purchased books on account from Readers Wholesale. They paid $3,300. Their terms are 110, net 30. Remember that from the previous chapter. I told you we'd be using it again. So if they purchased books on account, that means they got books, right? They're going to resell them, so they're going into inventory. They're going in at $3,300. And they still owe Readers Wholesale, so we're going to credit accounts payable for $3,300. Excuse me. So we're going to post those in the T accounts because it helps to keep track of this stuff, and you'll see why. So $3,300 debit to inventory and $3,300 credit to accounts payable. That increases inventory and increases accounts payable. May 3rd, pay cash for freight costs of $200 on books purchased. So these books that we purchased, we're paying cash for some freight costs. Freight is always added to inventory. It's part of the cost of inventory. So we're going to debit the inventory account for $200 and we'll credit cash for $200. So again, post these. Inventory debit 200, cash credit 200. May 5th, return books with a cost of $400 to readers because part of the order is incorrect. So if we're returning $400 worth of books, we actually owe $400 less. So we're going to debit accounts payable, $400. And our inventory is also $400 less because we're sending those back. Now let's post these. Debit accounts payable, 400. Credit inventory, 400. And then we're going to pay the full amount due readers. Now remember, our terms were 110 net 30, 1% if paid within 10 days. So we're paying it on the 10th day, so it's paid within 10 days. We're going to debit accounts payable to reduce what we owe them. How much do we owe them? We owe them $3,300 minus $400, or $2,900. So we're going to debit accounts payable, $2,900. I'm going to skip a line, and then we're going to put in the cash that we owe. How much cash do we owe? $2,900 less 1%, which is $2,871. The difference is actually the 1% discount. That 1% discount is $29. That will go to that account. Remember, where did we put the inventory to begin with? We put it in the inventory account. So now our inventory costs less. Oops, sorry. So we're going to credit inventory for $29. So let's post these. We're going to debit accounts payable for $2,900. That makes our balance $3,300 minus $400 minus $2,900, or 0, because we paid everything we owe. We're going to post the $29 credit to inventory. That makes that balance, it's a debit balance because it's an asset, $3,300 plus the $200 freight minus the return of $400 minus the discount of $29. That makes that balance $3,071. And then we'll post cash $2,871. And we don't need to worry about that. They probably had a beginning balance and we just didn't know about it. On May 30th, we sell all the books purchased on May 2nd, less those returned on May 4th, for $4,000 on account. Because this is a perpetual inventory system, it requires 2 journal entries, and don't mix and match them. The first one is the sale. What do you record when you sell something on account? Accounts receivable, debit, and we sold it for $4,000, and then sales revenue, credit $4,000. And I spelled this one wrong, forgot the E, got carried away. So now let's post those. Accounts receivable, $4,000. Sales revenue, $4,000. The second part of this entry when we sell the books is to record the cost of goods sold, because we're in a perpetual inventory system. So we always calculate our cost of goods sold at the time of sale. Our cost of goods sold will be debited, and our inventory will be credited. For how much? Well, how much do we have in there? We sold it all. $3,300 plus $200 minus $400 minus $29. So we have $3,071. And that's our cost of goods sold. And we'll post those, $3,071 here and a credit to inventory of $3,071. That leaves our balance in inventory, $3,300 plus $200 minus $400 minus $29 minus $3,071. That makes that zero. We sold it all. That's the perpetual. This last requirement we won't do. It was just if they sold it without the discount. Well, let's go ahead and do it. It's listed here. I thought it wasn't listed. So what if, no, it's not listed. So what if they sold it and didn't take the discount is what this last one is. We're going to kind of skip that one. So let's go on to the next one, which is E617. And this is the same thing, only we're doing it in a periodic system. And I set this so that it would bring over what we posted here. And it's showing the zeros because I carried it. We don't really need the zeros. And I'll take those out because that's confusing. I set it to enter automatically. So now let's do the same entries in a periodic inventory system. This is where we wait until the end of the period to record everything. So on May 2nd, when we purchased that inventory on account, we at the time debited inventory and credited accounts payable. Now we'll use this purchase account. So instead, we'll debit purchases for $3,300 and we'll credit accounts payable for $3,300. So let's post those, $3,300, $3,300. May 3rd. This is where we paid the freight. So in our perpetual system, we added the freight to inventory and credited cash. In a periodic system, we want to use this account called freight in. Freight in for $200. So we don't post anything to inventory during the period in a periodic inventory system. So freight in, $200 post, and cash, $200 post. Okay. May 5th. This is where we returned books. So in a perpetual system, we debited accounts payable, which we will still do because we owe them $400 less. We credited inventory because it took it out of inventory. But since we're not using the inventory account, we're going to use this purchase returns account. Obviously can't type today, I apologize. So let's post that. Accounts payable, $400, purchase returns, $400. Okay. May 10th. We pay what we owe. We still owe $2,900. It didn't change from when we did it in the perpetual system. We'll still debit accounts payable for $2,900. We'll still credit cash for $2,871. But the $29 will not be credited to inventory since we're not using the inventory account. It will be credited to purchase discounts. So let's post that. Accounts payable, $2,900. Purchase discounts, $29, and cash, $2,871. Sale. on May 30th. A sale is a sale. Debit accounts receivable, 4,000. Credit sales revenue, 4,000. Posted to the T accounts. Do we do this cost of goods sold in inventory? No. So on 5/30, the second one, no entry. Because we're not tracking cost of goods sold in inventory as we go. And I think I'm going to move this up one so we have room for this other entry. All right. Now we have to close out all of these accounts. We're at the end of the month. We're at 5/31. And we need to close out all these temporary accounts: purchases, freights in, purchase returns, purchase discounts, and calculate cost of goods sold. So our goal is to get cost of goods sold. We need to close the purchase returns account and the purchase discount account because they have credit balances. We're going to debit them. So we're going to debit purchase returns and debit purchase discounts. So that debit will be $400 and $29. Okay. We also need to close the purchase account and the freight in account. They have debit balances, so we need to credit them. So purchases, credit 3,300, freight in, credit 200. That leaves us with cost of goods sold. What is it? Well, what makes this journal entry balance? This is 3,300, this is 200, subtract 400, subtract 29, and come up with 3,071. Now our debits equal our credits. And that's the cost of goods sold. It's the same, it's just accomplished differently. So it's still 3,071. So let's post these. Cost of goods sold, 3,071. Purchase returns, 400. This makes this balance 0. Purchase discounts, debit 29. That makes this balance 0. Purchases, credit 3,300. That makes this account 0. Freight in, credit 200. That makes this account 0 as well. So the difference between a perpetual and a periodic is the periodic doesn't use inventory at all. In a periodic system, you just need to find another account. You do not use inventory until the closing entry at the end of the month. This is the closing entry. Okay, that's all I have for you today. I hope this helps. If you need help, again, post in the discussion board. If you need more than that, email me. And remember, we have tutors available and they will meet virtually or in person. Good luck. Have a great week.